Welcome to the Gower Crowd podcast syndication in the digital age with me, your host, Adam Gower. And today, I am delighted to introduce you to Neal Bawa, founder and CEO at Grocapitus, who has managed to convert a successful career in tech to one in commercial real estate investing. Now, the biggest challenge that most real estate professionals face, as you know, is how to bring tech into their businesses. In fact, one of the biggest challenges I face is in demonstrating to seasoned real estate professionals the power of using tech solutions to raise capital. Once you've been in the industry as long as I have, and as many pros have been, it is difficult to do things differently. You get stuck in the old ways that work, right? They've proven to work. So why change them? Those who do, however, migrate to the digital marketing world and the use of tech to raise money find it utterly liberating of their time. They raise more money in shorter periods of time with less effort. What you're going to hear from my guest Neal Bawa today is something very different. Here is a fellow, and I'm going to paraphrase what he says, who doesn't run a real estate company that uses tech. He runs a tech company that is in the real estate business. The language that he speaks is solidly one taken from his background in the tech world, and you're going to find it fascinating to hear what he has to say. You're going to learn how to create a pipeline of investor prospects by giving away something of high value for free, how to get emails opened even from cold prospects, and what cold prospects are exactly. And you'll also hear how in Neal's company, 2/3 of the employees are dedicated to marketing for capital and only 1/3 to the business of real estate. Imagine that, right? And as you are going to be learning a lot of advanced digital marketing concepts from our conversation today, I strongly recommend that you contextualize what we talk about by, if you've not already done so, watching the whiteboard workshop at gowercrowd.com, where I walk you through the foundational structure of a world-class digital marketing system. In combination with that, and from what you hear in today's podcast, you'll be ready to jump right in and start raising even more capital online faster and more effectively than you have ever done before. It's all there at gowercrowd.com and also on the podcast page at gowercrowd.com, where I've also included links to Neal and to Grocapitus. All right, now it is time to hear from a tech entrepreneur who has built a tech company that leverages real estate, not the other way around. I am pleased to introduce you to Neal Bawa, founder and CEO at Grocapitus. Neal Bawa, thank you so very much for being with me today on my podcast. It's a pleasure to meet you and to see you. And I have one question that I would love to kick off with. So there's actually a couple of things that are very interesting. We'll come back to the second one, which is a quote I am going to repeat back at you from your LinkedIn profile. It's really interesting. But before we do that, let me ask you this. You've been in real estate since, I can tell, since 2015, but you have a very long and illustrious tech background. So how have you connected the dots between the two disciplines of tech and real estate?
Well, firstly, thank you for having me on the show, Dr. Gower. I'm going to answer that question in a slightly elaborate way because it's an interesting part of my story. I am not in real estate. I am running a technology company that is masquerading as a real estate company. And it has always successfully masqueraded as a real estate company, and I think it always will be. So all I did was I moved from core technology to real estate technology. So that jump is smaller than most people think. When you look at the org chart of my company, I have 24 employees. It doesn't resemble the org chart of a real estate company. Obviously, there's people like underwriters and asset managers, and that looks like traditional real estate for somebody that's running a $300 million portfolio. But the massive majority of my company is actually running like a .com. And like every .com, we have a very outsized, massive focus on eyeballs, on content development, on having 12 or 13 different incoming pipelines, both for cold leads and for warm leads. And then we have entire departments processing cold leads and turning them into warm, and processing warm leads and turning them into investors. And so I think that if you look at the org chart of any other syndicator in the company, you'll find it's different from mine. So haven't transitioned to real estate. I'm still in tech.
I love that, actually. And I was hoping that would be your answer. So let's drill down on that. So 15 different pipelines coming in with investors. So what are the top three? What are the three that really drive the most converted investor traffic? And when I say conversion, I don't mean they gave you their name and email address. I mean, they sent you a check.
Right. So the one that has been the biggest has also been the one that's slowest. So there's a, so I'm going to tell you that story, and I'm going to explain how it happened. And yes, this is the one with the most checks. So when I was in technology, 2003, I was building campuses for my company. So I was basically in real estate, but I was a technologist running a real estate technology company, building these large custom campuses for our personal need, well, for our company's needs, right, using the company's money. So there were no investors. We were the investor ourselves. So when we're building these campuses, I got interested in real estate, learned about the depreciation benefits, and they were great for me because I had the big fat tech salary, 50% taxes. I live in California, so 50% of my salary was taxed. I saw the depreciation benefits. I'm like, ooh, this is great. I got to do more real estate, right? So I started doing real estate, after building those 6 campuses and getting those depreciation benefits. And I'm doing predominantly single-family real estate, and I'm basically, like any other good data scientist tech, I'm mining websites, I'm spidering the Department of Labor website, and I'm making copies of the Zillow website and taking all of that data and mashing it and trying to see patterns in the data. Like any good data scientist, we're trying to read the tea leaves, because one of the things that data scientists do differently is they come up with a hypothesis and then they use data to test it. Right? So they don't just go out and willy-nilly invest somewhere just because, it's 10 minutes away from their house or because somebody said it. They want to create a hypothesis and then test it. So I went through this process of testing a lot of hypotheses, and then I started publishing my results on the web, and people really liked what I was doing because I'm in Silicon Valley. Everyone around me is a geek or a dork, right? Take your pick, right? So we only come in 2 varieties here, geeks and dorks, right? So, or there's a third variety, people tell me uber dork, right? So amongst in this land of all these geeky people, I was like micro famous all of a sudden because I was basically taking hundreds of real estate metrics and I was applying them to hundreds of different cities and publishing my results. And so initially it started with people calling me to local meetups to present my ideas. And I've always been an entertaining presenter because I realized that, numbers are boring. So you really have to break it down to something that people can understand, right? 25 years ago, somebody had said to me, when you're teaching people, you're first an entertainer, then an educator, right? And if you get the entertainment part wrong, you could be the best educator in the world. Nobody's ever going to get anything right out of it. So I learned that lesson well. So when I'm teaching, I'm entertaining people. So people found it fun, and so local meetups started calling me in, and then podcasts started calling me, to do podcasts. I think this is my 120th podcast that I've done.
And good. I'm glad I've been so high up on your list.
That's right. Well, I'm going upwards, right? So
moving towards quality.
That's right.
All right, I'll buy that. All right,
yep, quantity to quality. So I did podcasts, and then people started calling me for conferences. Now, in the pre-COVID world, I would teach a conference somewhere in the United States every month. So about 12 conferences a year. Most of them are either multifamily or real estate or syndication conferences, though there's some that are outside of this realm, which are in the commercial real estate technology realm. And I have a space there. I'm an active investor. I'm a venture capitalist. So people are constantly pitching me commercial technology startups. So when I did that, when I was doing these pieces, what I realized was that no one was really publishing this content. If they had something good, they immediately went to a venture capitalist and they tried to get $100 million for it. So I said, I'm going to take the other approach, which is the Google approach. Google was giving Gmail away for free. Google was giving Maps away for free. I'm like, I really like this approach. I have no idea how to monetize this, but I'm just going to, I don't have to make any money because I'm a tech guy. I have a big fat salary. I'm just going to start giving stuff away. So I started building toolkits and then started building courses. So I built the toolkit. I called it Real Focus. And it's a It's a data-driven but very simple methodology on how to figure out the best cities and neighborhoods in the US to invest in. And then I said, the toolkit's good, but I should actually turn it into a course, and I should give the course away for free. So I put the course on my website, and there were like 100 people taking it every year. And I'm like, no, this doesn't work well. So what I did was I gave the course away for free without having access to people's email addresses on udemy.com. So udemy.com/realfocus. And I was like, if instead of 100 people, I get 200 people a year, I'll be happy. Well, it just exploded. So right now, if you go to udemy.com/realfocus, there's 7,000 people taking the course today, and there's 500 five-star reviews. It became the most popular real estate course on the entire website. They have hundreds of real estate courses, but it became the highest ranked and the most popular simply because what people liked the most, Dr. Gower, was that there was no agenda, right? I had nothing to sell. I was not a real estate guy. And so I was basically just saying, I am a Silicon Valley dork, and here's my findings, and use them if it's appropriate, and feel free to give it away.
Let me actually jump in there and ask you, because I have actually paused. I'm interested. What was the course about then? It was basically your data. You discovered that you could analyze data in order to identify good locations for acquiring single-family homes in the United States.
Or multifamily. So the course, it works slightly better for single-family than it does for multifamily, because on the multifamily side, you need an additional component, one additional component called supply. Okay, you don't need that for single-family. We didn't find a correlation there. So what the course does is it is a set of 5 rules for identifying the best cities in America to invest in, and 5 rules for identifying the best neighborhoods in those best cities, right?
Okay. And so this is entirely premised on data, right? This is
completely data-driven. It's a 100% data-driven, no gut feel, no experience. You're simply looking at data to make better decisions. And it's not perfect. It's really not a set of rules. It's a set of guidelines, right? Your gut feel still works. And so people started really to like it, and they started building upon it. They started developing it. They came back to me and gave me improvements, which I subsequently made to the course. And what happened was Udemy doesn't share those people's email addresses with me. So for it to become a successful funnel, when I did finally sell my technology business and move into real estate, become a syndicator, I now needed to raise money for my syndications, $3, $4, $5 million at a time. So I'm kind of scratching my head going, I have this enormous audience, but I don't have their email addresses because Udemy doesn't give it to us.
Right.
What I realized, though, is Udemy allows us to reach out to those people 4 times a month. So what I did was the same thing that you are doing, Dr. Gower. I hired content writers. And those content writers would write 3 emails a month about my content, and a 4th email a month that was basically a sales pitch for my projects. And
so Udemy lets you do that. You can say
twice a month, you can send out emails that have sales pitch content that is, you can have links offsite. And twice a month, you can send out content information.
I cannot believe we are talking about this. I swear to you, it's absolutely amazing. I lobbed a course up. I'm totally serious. I lobbed a course up on Udemy, I don't know, last year.
Right.
Totally forgot about it. I haven't looked at it since then.
Yeah.
Why not 3,500 people? Like, where the heck did these people come from?
Well, that's just the people taking it out. It's a very large audience.
I haven't sent a single email. Like, what the heck? I've just been trying to figure out how to tap into that. It's unbelievable.
So 4 emails, right? So 2 that can talk about your course and your content, and 2 that can talk about other stuff. And so basically what I started doing is I hired a content person, and I put them together with a virtual assistant. That content person would write 4 of these emails every month, and sometimes they were repeat. So it's not like they're writing them every month. They're repeating them every 3 to 6 months because people are coming and going. And then I've got the virtual assistant that posts them. And by doing so, I was able to drive a massive amount of traffic to me that was already branded traffic. The people that took this course love me. Right? I mean, because we pretty much get all 5-star reviews. So it's about averaging 4.8 out of 5. And so people love the fact that there's nothing to buy in the course.
Okay, so hang on. So now let me jump in now. Yeah. So let me ask you. So what you described to me a course, and I might be wrong because this is actually a challenge that I have as well, same thing. But you described a course that teaches people how to find deals, single family and multifamily with some exclusions, right, across the country, which implies that these people are out there trying to principal deals, right? They're trying to find deals to invest in themselves, to buy themselves, to raise money themselves. But now you're sending them emails saying, hey, don't bother with that. Invest with me. How do you make that switch? How do you transition to that?
Well, I didn't have to, because the course established my brand name as somebody that's data-driven for investing. And I didn't say that. I didn't say don't bother. I said, I believe everyone that took my course should be using it to buy their own properties. And if you were to come and ask me and say, should I only invest with Neal Bawa? My answer is no, that's a bad idea. My answer is that you should try both and figure out if you're the kind of person that can truly optimize properties by yourself, or are you the kind of person that wants to take a back seat? Are you the kind that just wants to buy Apple stock and sit with it for 10 years? You're not going to find that out unless you do both. And here's a course that allows you to go out and buy yourself. But note that I'm using the same course and the same methodologies to buy multifamilies, which have economies of scale that you do not have and never will have with single family. So you should look at my deals as well. So it was a very soft pitch. And even in that pitch, we were saying, but don't forget to buy your own single families, right? So it built more credibility, though it took more time. But over time, thousands of those people migrated to our webinars, our websites, our other things. You know, as you can imagine, we had lead magnets and things like that. So we were able to take an enormous audience and move them off. And because the credibility was already built, when the projects came in, our conversion at the end was phenomenal. It was 10x what a cold conversion is, or maybe even 50x.
It's absolutely
they were all drinking the Neal Bawa Kool-Aid.
Yeah, exactly. Well, you already built a relationship, or they built a relationship with you.
Yes, I hadn't built it, with them, and a lot of them eventually would call me and talk with me and praise the fact that I didn't even have their email address, because honestly, Udemy doesn't give you email addresses, right? So I didn't have any way of contacting them except for these 4 emails. So that's my biggest, most powerful funnel. There you go. Anyone can do it.
Amazing. It's absolutely fascinating. It's amazing that you should have said that. Seriously. We've just been looking into how do I tap into this bloody pipeline that I've got out that I haven't even thought about before. But now let's talk about kind of regular sponsors, right? So what are the other, so this is your number one funnel.
Yep.
For raising money. And what you've described is something that has taken a long time, requires a lot of patience, a transition into your deals. But at the end of the day, you are providing education, right, to prospects. So and you've made the distinction between warm and cold prospects. So these are all warm. Presumably, you define them as being warm.
Lukewarm, yeah.
Well, when you invite them to invest, they're warm. When they first discover you on Udemy, they're cold, right? They don't know who you are. They buy your, or they download your course. They look at the course. But what other funnels do you have that have worked well for you? And let's talk about cold, actually, because that's an interesting angle.
Sure. So we do both cold and warm leads, and we keep them in 2 separate databases. So we have what is known as our main database, and it has about 22,000 active people. And then we have what is known as a shadow database. A shadow database is basically cold leads or people that don't know us. And we dump massive numbers of people in there, and then we also remove them. One of the key things that we do that most people don't do is, if they're not interested, we get them out of our database, because what we find is deliverability levels for our emails go down if we let them be in there. So we're extremely Nazi. There are periods of time where our database is shrinking, even though we're adding large numbers of people. That's because we have a very aggressive removal policy. If they're not interested, the last thing we want is for them to clutter our database, because we're using high quality providers like ActiveCampaign or MailChimp, and keeping people in our database costs money.
What's your open rate?
So right around 25 to 30%, right? So for our nurture database, those 25,000 people, and so 25 to 35% depending on the email. And then for the other database, here's my feedback to you. a lot of people are like, well, I'm going to buy a list of 10,000 accredited investors from the web. And firstly, most of those are bad email addresses, right? So, once we've sent them through a cleaning mechanism and maybe we bought 10,000, now we're left with 5 that are actual good emails. Sending emails to them at that point in time, trying to sell them a $100,000 syndication is a waste of time. You shouldn't even bother. So what we did is that we first started inviting them to extremely content-rich town hall events that we do. So right now we've done 6 town halls that are the impact of COVID on X. X being single-family real estate, student housing, senior housing, industrial, multifamily, and so on and so forth. And what we do is we bring in guests who are told that this entire webinar, like 75 minutes of content, is zero pitch. You're not going to say what you do. We're not going to say what we do. It's simply high quality content. And lots of times people are like, no, I need to pitch something. Well, the answer is sorry, right? You can't. So what we do is we use our army of virtual assistants. We have 18 virtual assistants to find very high quality people that are like, brand building is enough. I know Neal has a huge database. It's not going to be 50 people on Zoom. It's going to be 2,000 people, right? So they know that. So they're like, fine, I don't need to pitch anything. I'm just going to come and talk about my experience. And so we bring in these high quality people and we do this 75-minute event. And we basically push that out to the cold database. But there's a tweak in there that I think most people listening will find very compelling. If I send that email from neal@grocapitus.com, the conversion and open rates are very low. So what we do is we send the email out from Eventbrite, or from LinkedIn, and from meetup.com. So those are 3 of our channels, as you can imagine, right? Eventbrite doesn't create a lot of registrations by itself. So, if you post an event on Eventbrite, you might get like 5 people, right? But what I do is I basically take my cold database and send them the email invitation through Eventbrite. And because of the brand of Eventbrite and the fact that nobody wants to unsubscribe Eventbrite, I get a much higher open rate and a much higher engagement rate because the halo of Eventbrite.
That is genius. How do you do that with LinkedIn though?
LinkedIn actually now has a function called events. So we have a full-time virtual assistant that reaches out to 200 people on LinkedIn. We pay for the higher level LinkedIn, so we actually can segment by income. So what we do is we target people that are VP level or higher, and companies we know they're accredited, and then we reach out 150 people a day to basically
manually you send them messages over LinkedIn.
There's software that does that, but yeah. So we basically do that. 150 people, some percentage of them connect with us. Once again, they're worthless to us at that point in time. People connect with 20,000 people and don't get anything out of it. But LinkedIn events, sending them these kinds of high quality events, right? That makes all the difference. And then the other piece that we do is you're inviting somebody to your event. Let's say Dr. Gower has the best content-driven no-pitch events ever, okay? The problem is this. What people don't do is they don't get reviews from people that watch their events. So what we do is when we have these content-driven events that 2,000 people have watched, we keep sending emails to them saying, could you consider writing us a review? So we solicit reviews, right? And then we take the best reviews, and in our next invite, 50% of the space in that email is filled with reviews, right? And 50% of it is about the content. And then we keep asking people to give us Zoom video reviews, and we put those Zoom video reviews in there. So now you've got almost 2/3 of an email that we're sending out filled with reviews from people that have been watching our events, and those are both written reviews and video reviews. That doesn't improve the open rate, but it massively increases click-through rate, right? So now we've got super cold people coming in through lists. I mean, LinkedIn is the equivalent of a list, right? And so is meetup.com, so is Eventbrite. But by inviting them over and over to these pitchless events, we turn them warm. When they turn warm, and we have obviously data and metrics around that, we transfer them to the other database, and now the drip campaigns start, and the invites to raises start.
Fascinating. Gosh,
now, Yeah, I
Yeah, go
mean,
ahead, go ahead.
but I mentioned 3 channels. I mean, there's a dozen such channels. So what we have is 2 completely separate databases. The shadow database's job is to move people into the main database.
Fascinating. Now, you also do advertising, don't you, Neil? Tell me
Yeah,
something about what you found works with
we
advertising.
spend hundreds of thousands of dollars on Facebook ads. We've tried Google. We've tried all sorts of others. Facebook works the best for us. But again, the devil is all in the detail. I know that many syndicators have tried Facebook. It's extremely expensive, doesn't work well, conversions are low. My feedback to them is it's because you are not creating lookalike audiences of your accredited investors, right? So let's say I have 500 accredited investors that love me, right? You have to, for a moment, stop being paranoid, and you have to upload those 500 investors to Facebook as a look-alike audience. Then what we do is we basically target extremely rich areas of the United States and only run Facebook ads on those areas. So what we're doing is we're targeting for income. We're targeting for look-alike audiences. We will frequently buy a list of 1,000 MDs who may have no interest in real estate, but we upload them to Facebook as a lookalike audience. Well, now Facebook starts serving our ads to MDs. All MDs are accredited. Therefore, our click-through ratio improves. Now, take that and multiply it 100x. I mean, it's the same strategies, but applied across a bunch of different platforms, across Instagram as well. You know, we apply it across so many different platforms. And that's why I keep saying that almost 2/3 of my company is, 15 people. Their job is
That's
just
really
to do
amazing.
this. And then there's the usual 8 or 9 people that do a regular syndication company's job, asset management, investor relations, or all of those other pieces, underwriting, finding properties, managing properties. That's 1/3 of our company, right?
So you don't have to answer this question, but with that kind of balance, and I deal almost exclusively with real estate sponsors, but with that kind of balance, 2/3 of the people internally are on marketing, and then 1/3 are on real estate development and sponsorship. If you raise 50 million a year, what percentage of that 50, how much is it costing you to raise that 50 million, do you figure, as a percentage?
$500,000 or $1 million, somewhere in that range. So it's costing us $500,000 to do that. But what, $50 million of equity is a $200 million of assets.
It goes a long way. So you see a lot of real estate sponsors, right? So you've come from the tech world, and what you're describing is rocket science.
Mm-hmm. Yeah,
it's very exciting to talk to you about this. But what do you see in real estate sponsors, right? There's these, so many people I deal with have got, in some cases, multiple generations of experience in real estate, no experience in tech or in marketing in this way, right? They've only ever raised money in person. Right? Imagine that, right? The mind boggles. It's all I did up until recently, right? I mean, it was prohibited to do anything else up until recently. So what do you see when you see sponsors out there? So you're talking to a sponsor audience right now. And this is an audience that is curious, but not converted yet to the idea of raising money online. What do you say to them? I mean, what do you see in the real estate industry and sponsors and the way they deal with tech in this way?
It's really mindset. There's a comfort level in raising money in person and meeting people at Starbucks. My message is this: I haven't been to Starbucks for a year, and even before that, most of it was to meet existing investors. I haven't been to a meetup group for 2 years. I think meetup groups are a great place to get started, right? But even when you go to a meetup group, in my mind, we will have a vaccine in about 4 to 5 months. I think that 6 months from now, people will start going to meetup groups again. So, it was a one year pause, but I still think it's a great source. But when I see people doing these activities, and I'll give you online examples and offline examples, I think that there is a real lack of intent. People basically will go in and then they will expect money to happen. What we've discovered in our company is everything is done with intent. And I'll give you specific examples so you understand what the heck does this intent thing that Neal's talking about mean. But bottom line is this: you've got to make sure you understand the mindset is you can raise money online just as much as you can raise money in person. You've got to use tools. You've got to get in front of people. FaceTime matters. Look at me. I mean, I've got the background, I've got the logo, I've got all of that set up, I've got the camera with the lighting. This stuff matters a great deal, and I think people don't fully understand that, right? And also, you have to build a brand to do this online. I have a very simple brand. I mean, mad scientist of multifamily. If you type that in, there's only one person you're going to find, and it's Neal Bawa. And my name itself, Neal Bawa, is a brand, right? So I have 100,000 people that know me. The process of building the brand was very deliberate. And people are like, no, I'm trying to build my brand. No. How many hours in a week do you sit down in a meeting by yourself or with other people to say, this is our brand building time? Do you have in your calendar a day which is a marketing day? You have on that day sections of your day which are like brand building activities. And are you trying a half dozen things? That's intent. That's you going out there and saying, I refuse to do anything else during this time except build a brand. And that has nothing to do with getting investors. Building a brand is a process of becoming an influencer. And then as you do that, then you start a separate process of bringing cold leads into that influence funnel. What I find is people don't spend enough time thinking about what is their brand? What do you care about? I care a great deal about numbers, right? I've only ever come up with one quote in my life, but that quote was, the Bible got it wrong by one letter. One letter. It is not the meek that shall inherit the earth. It's the geek. It's the geek, right? And richest man in the world, geek. Second richest, geek. Third richest, geek. Do you see a pattern there, Dr. Gower? Do you see a pattern developing, right? We had a guy who's a geek who just got divorced and paid $38 billion to his wife, and he's still the richest man in the world, right? So it's the meek, it's the geek that are taking over the world. And I have belief in that. So that's what I care about. And so I build my brand around that. I don't see enough people doing that with intent.
And that's fascinating you say that. So I'm going to ask you a follow-up question to that by excusing those who aren't building with intent. And those that aren't building with intent, which is, in my experience, you are extremely unusual in the real estate industry. But in the real estate industry that I know, everybody spends all their time trying to find deals, executing on deal flow, spending a lot of time going through what I call the dog and pony show of raising money by arranging to meet with people in person a dozen times before they actually pitch a deal, et cetera, et cetera. When you got into this business, you made a conscious decision that you were going to, I'm not putting words into your mouth, but it looks from your resume like you reinvented your career at some point. You moved from, and you've said you'd moved from tech, but you migrated that into real estate. There was a conscious decision and then presumably a period of exploration before you discovered what works and started finding deals, et cetera, et cetera. But for somebody who is spending all their life trying to find, all they've ever done, find deals, how do they justify the time to switch off to build a brand with intent? How do you justify? Don't you have to stop business as usual to do that?
Honestly, it's not different from any other discipline. So what I would ask you to do is, don't start with 50% of your time going towards brand building. Commit to, let's say, 10%. So if you're committing to 10% of your time going on brand building, right, then what that means is all you need to do is look at your existing deal finding, deal activities, and figure out which 10% is the lowest yield and get rid of that. Because if you don't, you're in the rat race and you'll forever be in the rat race. I find a lot of people get into real estate to escape the rat race, and they never actually escape the rat race. They've just gone from a W-2 rat race to a real estate investor rat race. There's no actual difference. For me, though, I come schooled with Silicon Valley thought, which is, you must look at the exit, right? So here's a question that no one in the history of syndication, no one in the history of multifamily syndication has ever asked, and I'm always irked why they haven't. What is your exit? And when I ask this question, this is my favorite question to ask because it really trips up people. They're like, no, I don't have an exit. I mean, my company doesn't have any value. The value is all in my building. So if I fund a project, then I'm going to make money on that project when it sells 3 or 5 years from now. So And I look at that and I said, don't you see that as a failure? It's like, no, I'm making money. And the answer is no, it is a failure because your core company, the company that you built, the one that does these syndications, it really has no value. It has no value. If the value is all in your investor database and in your properties, well, then you can never exit, because the moment you stop doing these projects, the value of your company falls to zero. And they're like, yeah, I have to continuously do these projects. And the answer is, that is an awful thing. It's absolutely awful, because in other businesses that we run, we always have an exit in mind. We have an exit saying, I will build up my company's net profit to $20 million. I'll get a 10x multiple, so it's going to be worth $200 million. That's what my selling price is, right? I've never heard people in real estate do that. So from the very beginning, I knew that this place was structured wrong. So I have an exit in mind. And for that exit in mind, I needed to build a competency in my company so that if I could take this to a venture capital company and I could say that my company, it's called Grocapitus, my company Grocapitus will continue to make you huge amounts of money on your investment after I leave. And here's why. That's the company I wanted to build. And so my question every day is, how can this company continue to make huge amounts of money if I wasn't involved? And every day I ask myself that question, and every day that question comes back to, well, build a personal brand and then transition it into a company brand. Build a massive amount of competency and systems that have value to anyone that's a venture capital person, and then continue to pull yourself out of it to the point where you're doing nothing. And then sell it at that point.
Yes, but what you're describing is the process. So my question, you've just described the process. I get that. But what is your exit? What is your exit? How do you make a 1,000x on an investment? How does a VC make 1,000x or 10,000, whatever they're looking for, by investing in your company? I understand the real estate exit. But it's a very different mentality. The real estate exit is, I want to leave a fortune to my children so that they can leave it to their children, right? It's a super long term. Realty shares, venture backed, had an exit in mind and collapsed, not because their thesis was wrong, not because crowdfunding real estate was wrong, but because the money that backed them had a different motivation, was in contradiction to the natural flow of what real estate is really about. So what is your exit, actually?
My exit is straightforward. I'm building the largest non-institutional equity funnel in the industry, in the real estate industry. My goal is not to take any money ever from family offices, not to take any money from super high net worth investors, which allows me to have 100% control of every deal that I do. What I'm doing is building an engine to bring in ever large amounts of equity. And if I am able to display and show and demonstrate to a private equity firm that this funnel will expand regardless of whether I'm here or not, they know that my company will make more money every year with or without me. And then I get a multiple two different ways. Obviously, all the properties that I'm involved in, I have an exit for those properties, but I also have an exit for the base company, Grocapitus. I'm well on my way. I think within 2 years, I will be able to walk into a venture capital firm in Palo Alto, explain to them what exactly I have done, and say, I intend staying on because I'm enjoying myself. But if I don't, you're going to buy the company not because of Neal Bawa. You're going to buy the company because of what I've built. And some of them will say, no, not quite. And the answer is, I'll be back in 6 months. And I'm going to show you how much progress I've made in the last 6 months. Not me, but my company's progress. My funnels, my systems, my incoming channels are so powerful that I'm becoming basically the largest of my kind in the US. So and that has incredible value.
Neal, are you competing then with sponsors, or are you competing with marketplaces like CrowdStreet and Real Crowd and Realty Mogul, etc., Fundrise, for example? Who are you competing with?
Currently, I'm competing with both. So, I sometimes will provide equity, let's say a $10 million check to a developer. But, and again, this is part of my story, I never wanted to be somebody that writes equity checks. So what we do is we stay in the project. We have asset managers, we stay in the project, we manage the project. We have an army in the Philippines that, generates 20,000 tenant leads, processes those tenant leads in real time, sends out 50,000 text messages, schedules appointments. We have another army that basically works with developers that are selling townhomes, and we do the sales for them. So it's not just us raising money for the townhomes. We sell the townhomes. So the developer is basically just building, right? The beginning and the end is us. We build the websites to sell those. We generate the lead flow. So we build systems so that we can have developers do what they're good at, which is developing and building. And we can have syndicators do what they're good at, which is finding and managing properties. And with us adding the top layer of massive amounts of tenants coming into the property, right? So we're bringing 10x or 100x the eyeballs that they're capable of doing by themselves because they don't have the infrastructure that they've built. When I go into a venture capital firm and say, I'm the only company in the United States that has this infrastructure built, and let me show you what I did in the last 12 months with this infrastructure and how it affected my properties, that's sellable.
Okay, very interesting. Yeah. So
I'm not in any bucket. I mean, I'm a one-off. I do what I like, right? Because I have no one that has invested money with me. I have no backers. I am my own investor, and I intend never to change that. I do not want to take money from anybody.
And obviously, you're having a lot of fun, which is the most important thing.
That's the key. People ask me, how long do I stay? And the answer is, as long as I'm having fun. But there's no doubt in my mind that this is not going to be fun for me in 5 years. So unlike many people, come
on, Neal, don't be so pessimistic. You're an optimist.
Most people lie when they say that 5 years from now, they'll be having fun doing what they're doing. I think, and I know there's some different people. I was speaking to one of my peers. His name is Brian Burke. He runs Praxis Capital, well-known company, hundreds of millions of dollars. He says, Neal, I don't know how to do anything else. So this is the only thing I can do. And I said, Brian, you're blessed in one way in that it's this simple for you. But for somebody with a mind as creative as me, doing the same thing 5 years from today is a failure. So we're two different kinds of people. There's no right and wrong here. So for me, 5 years from now, either Grocapitus will do something totally unique, different, or next level, or I'll be off doing something else, where Grocapitus will either be owned by a venture capital, or the other exit, which I like equally, is I'm going to promote my managers to CEOs, and I'm going to become chairman, show up once a quarter, and take a look to see what they're doing.
Right, and then all you'll do is, sit on a beach somewhere listening to music. I doubt that.
I'm not much for sitting on a beach, but I'll go do something else that I find interesting.
Right. All right, so I'll tell you what, Neal, you're a very interesting fellow. I'm so glad that whoever it was on your team called me. I'm really glad to meet you. It's a real pleasure. I have heard your name. Somebody actually approached me to help them build some systems for them, and they asked me, have you heard of Neal Bawa? And I thought, well, I have to confess I had to look you up, but I'm very happy to meet you at last. It's a real pleasure. Let me, if you don't mind, let me ask you, I actually have 3 sign-off questions, and I could be more than, you say you're a busy day, I'll be happy to speak to you for the rest of the day. But I know neither of us have that time. But I would have 3 questions that I ask all of my guests.
Sure.
But I'm going to ask you a 4th one, if you don't mind. I'm going to start off with the 4th one. And the 4th one actually is, what have you found to be the biggest challenge finding investors? You've described what you've discovered works, but unwrap that a little bit. What is at its core, what is the hardest part of finding investors for real estate deals?
That's a very challenging question for me. Why don't you ask me the others and give me a few extra seconds to ruminate? I have had very few challenges finding investors. Therefore, that question is almost it's an Achilles heel question for me, but I'll figure it out.
Okay, I'll let you ruminate. I'll go then to my.
Actually, I got it.
Okay, perfect.
But I'm going to cheat. I warned you I'm going to cheat, right?
Sure.
The biggest challenge with finding investors is that the massive majority of people investing in crowdfunding don't have regular funnels. So what you do is you spend an enormous amount of time and effort finding an investor, and then he gives you 50 or 100,000, and then he doesn't have money again. So the challenge is the minimum investment with syndication being 50 and 100 grand, people can't repeatedly invest. So your funnel is a very one-time funnel when you start out. Now, as you can imagine, I have already found ways around that. But when I started out, it was like, so this guy loves me, and I've spent all this time, and he gave me 50 grand and he's done, and he's probably going to come back 2 years from now and he has more money. That truly sucks. I want a subscription. I want to give me $50,000 a month. How do I do that? That was a big challenge, right? Because it's just such a huge amount of work to get an investor
to get that one person through.
Right. And then they give you 50 or they give you 250s, and then it's like, well, I don't have money.
So how have you cracked that challenge?
Well, the short answer is this. We became very, very fanatic about focusing on the very high-end salaried individual or somebody that was, high net worth. Now, when you do that, you're essentially throwing away 50, 60, 70% of your lead flow. But by targeting high net worth individuals that are high net worth and doctors and so on and so forth, we changed our pitch. We refined our pitch. So our targeting mechanisms and our hit rate became a lot better. And that allowed us to basically leave aside everybody else that's the $50,000 a year person. And I'm not saying we don't get money from those people, but we do absolutely nothing to try and get money from them, except for send out blast emails, right? We do 506C projects. We don't touch 506B. And so the other piece that fixed it was we basically said we are not going to do 506B projects. We are going to do Cs only, which means that from the very beginning we know that we're going after accredited investors, and that's our only domain. That's where we live. And I'm shocked that syndicators have been syndicating for 5 years and still doing 506B projects. In my mind, that is a cop-out. It's cowardice. They need to move up to the real game, which is 506C.
Fascinating. All right. So here's my last 3 questions.
Go for it.
First, for a seasoned real estate sponsor, somebody who's been in this, all their life and is new to tech and the idea of raising money online, what is the most important thing they should keep in mind when they're starting out syndicating their deals online?
Most important thing that they need to keep in mind. Investors get a good gut feel or a bad gut feel about you, and that never changes, and it permeates through your entire database. The words that you use matter a great deal. So take your time, go a little bit slow. Don't try to sell one deal. Try to sell your competency. And in fact, do the takeaway deal where you say, it doesn't look like you're ready for this one, but you'll be ready for the next one. There'll always be more coming. That takeaway process is one that people don't use enough, and it gets us lots and lots of sales. So we basically don't try and sell any particular deal. We sell our competency. So develop that competency, whether you have technology skills or not. Doing that is going to give you a long-term pipeline that's much better.
Second of my last 3 questions. What has been the hardest lesson you've learned online?
Online. So
yeah.
That's an interesting one. I was going to give you the hardest lesson. I was like, well, that one isn't online. This is kind of an offline lesson. I think online it is that deals look very, very good on paper, especially on digital paper on the internet. And so at some point I became so overconfident and cocky that I thought that data and systems would kind of make up for the fact that the boots on the ground was not there. And what I've discovered is you can never in the real estate business get away from the boots and ground. All that the data does, all that the targeting mechanisms do is make you more efficient, but they don't reduce the boots on the ground need by even 1%.
That's very deep insight. What was your offline hardest lesson? Gotta know.
Don't invest in markets based on their future growth. Invest based on where their growth has been in the last 24 months. So too many people are like, here's a ghetto area, but someone's building a golf course on the other side, or someone's building this massive building a mile away, so this area is going to improve. The answer is, please only invest your own money on those kinds of premises. I've invested other people's money that way and learned the hard way that some of those things can get delayed. You have the best of intentions, you're not trying to do anything wrong, but stuff gets delayed, stuff gets canceled, stuff gets pushed out for a variety of reasons, and now you're running a project that's suboptimal in some way. Maybe it's tenancy, or maybe it's demand, and it's not worth your time, and it's not worth your investors' patience.
Last question. You are an avowed geek.
Yeah.
In the nicest possible way. So, as somebody as accomplished as you are online, what are your key daily habits to remain successful in the online world?
My key habit is an offline habit that makes me successful online, and it is following the miracle morning. Other people call it atomic habits, but it's essentially that hour of the morning that gets you set and started up. I highly recommend The Miracle Morning. I tell people it's the most important book in the world. It's not the best book in the world. It's probably not even close, but it's the most important book in the world because if you follow it, you'll probably end up reading hundreds of other great books, including the best book in the world, whatever it may be for you.
Neal Bawa, what an enormous pleasure to meet. I knew you were a geek because when I read your bio, you said you like cricket. Yep. And you're the only other person in America that I've come across in all my years that even knows what that is, that knows it's not a small insect.
Well, somebody like you, I mean, obviously you remind me of one of the most elegant batsmen of all time had the same last name as you, right? He may not be the greatest, but he was definitely one of the most elegant of all time, right? He was just fluid grace. So I was like, oh, Gower. Yeah.
Neal, what a pleasure to meet you. Really wish you the very best of luck. Thank you so much for spending your time. I know you're very busy. Thanks for spending your time with me today.
You're most welcome. Thanks for having me. Bye, Dr. Gower.
That was Neal Bawa, founder and CEO at Grocapitus. And for sure, watch the whiteboard workshop at gowercrowd.com, where you'll learn how to build a best-of-class digital marketing investor acquisition system and be able to apply many of the lessons learned from our conversation today in today's podcast. All there at gowercrowd.com, where if you go to the podcast page, you'll also find links to Neal and to his company, Grocapitus. That's it. Thanks so much for listening. And thank you, Neal Bawa, founder and CEO at Grocapitus, for your time with me today. It was a real pleasure to meet you. That's all for this episode. I'll see you next time. And in the meantime, stay well. And for now, this is Dr. Adam Gower signing off.